What a crazy week it has been. The Nasdaq 100 down nearly 4%, momentum unwinding, the economy slowing, a peace deal probably off the table, and bulls getting absolutely slaughtered. Now, can things go from bad to worse, or is this peak pessimism as bearish sentiment has hit capitulation levels and the bears clearly in the driver's seat? That's what we're going to talk about today, along with, are we in the middle of a growth scare or a momentum unwind? Obviously, we can argue the data on both sides, but I'm here to cut out the noise and bring you the facts that matter and the data that'll put you on the right side of the trade. So grab your whiskey, take a sip. The bad news isn't over just yet. What comes next? That's the big question. So we've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks ended Friday on a high note after a brutal week of trading where geopolitical drama played out in the White House and unease over Trump's tariff threats permeated through the wider set of economic data. It was a very green day across the board. I mean, the only red was just like a couple of earnings plays. For example, Dell was down 4.7%, Accenture was down 2.35%, but that was it. It was green across the board. We saw a rebound in Nvidia, Apple, Microsoft, Google, all of the big names, retail trade. It was just a risk on rally after what was a pretty brutal week for equities as a whole. You could see it was green across the board. In fact, the only asset that lost today was actually gold, down 0.65%. S&P 500 gained 1.6%, and it was green across the board. Obviously, large caps were the best performing asset here today because they, lost the most this week. Large cap growth up 1.35%, but it was green across the board. Value, core, everywhere was green. If you were just indexed today, you saw upbeat momentum in your portfolio. The worst performing sector was actually small cap value. And again, this just goes to the fact that we just saw a bit of a risk on rally today, and you're going to go into, large cap growth names. So now we have to ask the question, why were we very green today? And that question is very, very simple. Number one, today was just a little bit of a bounce back from the week. It was a pretty brutal week for indices across the board. We had some very, very red days. Sellers taking profits. You could say it was a dead cat bounce, and buyers also just maybe seeing value in certain indices. Certain stocks were down like 15% from their highs, stuff like Nvidia, Google, Meta, and I think what we really saw was investors buying the dip, and that is why we saw an uplift here in equities. Another reason was the economic data. Now, we got PCE data, which came roughly in line. Core PCE month over month came in at 0.3. That was exactly the consensus. The headline figure came in at 0.3 as per the consensus, and the year-over-year figure 2.5% versus 2.5%, exactly as per consensus. Now, there was a couple of bolts here. Personal income actually rose more than consensus. That's actually very, very good. However, personal spending for this month actually fell compared to the 0.1% gain. So consumers making more money this month, but spending less money. But net inflation came in as per usual. And I would say that this economic data was very, very positive. And that really did help support stocks early on in the day. And that's why we saw a rally pretty much from start to finish on today's trade. However, there was a couple of risk factors that the market did wobble midday. China came out. They promised countermeasures after Trump threatened additional 10% tariffs. So pretty much part of the reason why we saw a lot of volatility this week, Trump came out and said that on the 3rd of March, Canada and Mexico tariffs will continue as per usual, and I'm going to add an additional 10% onto Chinese tariffs because Chinese tariffs were only set at 10%, whereas Mexico and Canada tariffs were anywhere from 20 to 25%. So he slapped an additional 10% on US tariffs. China vowed countermeasures, and this could be a minor risk factor looking ahead for the week. However, today, here on Friday, very, very positive. Nvidia gained some momentum back after yesterday's selling. It rallied just shy of 4% today. Very, very volatile trade. Net Nvidia was up, and I still think anything below $130 is a great deal, especially if you're going to do $6 in earnings per share next year. You add a simple 20 multiple to that, you get $120 per share. The stock pretty much trades at that price. And if you look at next year's earnings, Nvidia looking very, very cheap, trading at just a 20 PE multiple. Dell was down 4.59% today. Now, you guys can go and check out my second channel, FinFluential Media. I break down Dell's earnings and why this was the case. So you guys can go ahead and have a look at that. But just to give you the quick breakdown, they reported very mixed results. They missed on top line, beat on bottom line. Q1 guidance, they missed on, but full year guidance, they reiterated. Very mixed returns. And when you have uncertainty and mixed guidance in this type of environment, you're going to get a situation where Dell gets sold off and investors just saying, hey, I can look to other opportunities. HP also reported their earnings and they actually lowered their guidance on the back of Trump's tariff policies. They say it's in a way on their outlook, and the stock was down 1% for the day, but positive nonetheless at some point in the day. So maybe the valuation of this name really lends itself to having discounted all of that bad news already, but I don't follow the stock that closely. Now, a really concerning sign was Redfin Corporation. They were down 12%. Redfin is pretty much an online real estate company, and their fourth quarter earnings came in below Wall Street's expectations, and their outlook was discouraging below Wall Street's expectations as well. The company posted a net loss of 29 cents for each share of common stock, and the expectation was 23 cents, right? So a huge miss there. And revenue guidance for the next quarter was in a range of 214 to 225 million. The street were expecting 244 million. So it was a double miss and lowered guidance. And I don't know how this stock is not down like 25% on the back of this news, but this as a read-through for the housing market, not looking good for 2025. And then looking at market breadth, we saw pretty positive market breadth today. 3,900 advances, 2,400 decliners. We saw net inflows throughout the entire day. The S&P 500 up 1.59%. Very positive inflows to lead the day, led by the NASDAQ 100. However, market momentum still remains sour. We did see tangible improvements in a lot of these moving averages. However, we are still below the 50% mark at shorter term, medium term, and longer term averages, still looking rather sick if you ask me. But let's hop on the charts. Now, guys, diving into the charts, this is the month of March. As you can see, the S&P 500 for the month of March fell 0.82%, but at one point was up nearly 2.5%. And guys, what we saw was a very, very clear uptrend into the middle of February. And we sort of formed a top right in here. So what we saw with February was a very clear uptrend into the middle of February. Then we put in the highs around Valentine's Day. And then we actually made lower lows, lower highs into the end of the day, finishing negative for the month in the S&P 500. And if you actually go look at typical seasonals for the S&P 500, this is actually perfectly normal. We see an uptick into February, and around the middle of the month, we actually see the S&P 500 pull back, finishing negative. So seasonally, February did what February normally does, and that tends to be just a volatile month in aggregate. But let's go ahead and add the Qs. This is the NASDAQ 100, the equal weight S&P 500, the IWM, the Russell 2000, and the Dow Jones. And you can see that the S&P 500 sort of performed in the month of February in the middle of the pack, down 0.82%, but the RSP was the best performing index, only falling 0.72%. The Qs was down 1.29%. But look, in the middle of February, as high as 5%, absolutely insane. So we did see a massive drawdown. Dow Jones down just shy of 2%, and the IWM falling just above 5%. Now, for everything we saw, like with yields market, the geopolitical tensions, tariffs, and the weakening economic data, equities, especially large cap equities, were rather robust, if you ask me. But the drawdown from the highs in the Qs, that is a little bit concerning. There definitely were some bright spots in the market that does make us a little bit concerned. For example, staples. Staples were up 4.13% XLP right here in the month of February. There definitely was that defensive rotation occurring under the hood. But I still think equities for the most part were very, very resilient. If we actually look at the year-to-date chart, we can see again, staples up 6% year-to-date. The Qs down 0.4%, so it's actually negative on the year. The Russell 2000 down about 3% for the year, but the SPY up 1.6%, the RSP and Dow Jones up 3.1 and 3.4% respectively. So there definitely is some risk on sentiment sentiment in these and the broad market rotation is occurring. It's just that the inflows here into staples can be a little bit concerning. But all in all, I think equities did look really good, especially going into the middle of February. We just have to see what this means for the rest of the year outlook. But if we actually go ahead and actually just remove all of these and talk about the S&P 500 and what we actually did today, a very, very interesting day of trade. Now, equities across the board were very, very green. We're seeing a little bit of red action here in the after hours, but inconsequential really when you look at something like the NASDAQ 100 that was up 1.62%, the S&P 500 up roughly the same. Mid caps gained, small caps gained, but really it was a day for large caps, large cap growth, large cap tech outperforming the rest. Now, the dollar did rise 0.25%. And again, that probably had to do with some of the news coming out of China, but yields did fall as well. And again, that had to do with the inflation data we got. So in line / better than expected inflation data, yields are going to fall. The dollar rose on the back of China tariffs, and then bonds gained because yields fell. Very, very simple trade here today. Everything just makes perfect sense. The VIX was down 7%, still below the 20 level. So volatility, not particularly elevated. And then we look at gold. Gold fell 0.6%, silver down. Commodities as a whole, a bit of a dumpster fire. But let's actually go ahead and look at Bitcoin, because even though Bitcoin was down 0.28% today, if you actually look at it peak to trough, right, from where we're putting the low to where we closed, Bitcoin was actually up 8%. So it does look like Bitcoin is trying to hold this level right here, call it the low to mid 80s. That's what Bitcoin is trying to go ahead and hold that level, trying to find support right here. If you are a Bitcoin bull, you're probably going to step in here and, buy. And if it does go lower, dollar cost average. I mean, the volatility of Bitcoin, especially if you are a Bitcoin bull, a Bitcoin maxi, shouldn't really scare you. And this should be a place where you get in and go from there. By the way, my end of year Bitcoin target is 130,000. Nonetheless, you're looking at about a 70% return from here if we hit my end of year target. But let's actually go ahead and talk about the S&P 500 because there were very positive developments. Let's actually zoom in. Number one, this is a fantastic bullish candle coming off the support. You see, we put in a low right here, had some price discovery below with this candle. So we did see the bears come in early on, but we put in a low. The bulls took us all the way up and we did go ahead and close in positive gamma. That's positive for the S&P 500. However, there's a lot of work to be done here on Monday, especially as it pertains to some of these highs. Now, what I want to see on Monday is a continuation, right? Strong continuation on Monday and go ahead and take out this high right there. If we go ahead and do that, I think that probably means we continue the momentum upward. If we don't go ahead and take out this high, I think we're going to see a little bit of a fake out and then we're going to continue to move lower. So everything on Monday comes down to whether we take out this high right here. This was Thursday's open. Okay. If we go ahead and take out Thursday's open, that's very, very good. It would be better if we can actually go ahead and close above Thursday's high. But this is what you want to look for Monday. On Monday, we want to see strong momentum. Go ahead and close above that level. If not, I think we're going to see more choppy / downward price action here in the S&P 500. Nonetheless, this was very, very positive price action. And as long as we stay above positive gamma, you know the game. We buy dips, sell rips, and we look for the 6050 area or the core resistance. So right now, that's what we're doing. But Monday, we really need to go ahead and close above that level right there. This is very key because there's a ton of volume right here. The reason why this area is so key is because there are a ton of shorts right here. The second we go ahead and close above here, shorts are going to cover and that's going to provide a tailwind for us to move higher. So there's a ton of shorts right here and they're going to defend this area with absolute certainty. That's why this is such a huge area. So that is the S&P 500. The NASDAQ 100 has a ton of more work to put into. What I want to see on Monday and probably what I want to see for the rest of next week is the NASDAQ 100 to move to the gamma flip zone. That's what I want to see. I just want to see us go ahead. Yes, they could be, it doesn't matter what the price action looks like. I want to see a close next week on Friday at above or at near the gamma flip. And wherever the gamma flip moves, that's what I want to see next week for the NASDAQ 100. So the NASDAQ 100 is not trying to clear any levels. It's just trying to get back the gamma flip and very much the same for the RTY. That's what I want to see. I want to see price action and momentum towards the gamma flip. Then we can target higher levels. But this is a great buying opportunity. I added EV, VTY again today, and I added to some of my ETF positions, particularly the ETF QUAL and QSML. The risk with the RTY, the Russell 2000, as well as the NASDAQ 100 is that if we get here and there is clear resistance at the gamma flip, that probably means we do go lower. So that's why I want to see next week close at or near these levels in the Russell 2000 and the NASDAQ 100. And then on Monday for the S&P 500, it just needs to go ahead and close at or above these levels right here. And then we'll decide what our next move is. But this is critical for Monday's trade. However, if we continue to find resistance here, that probably bodes not too well for stocks, and we probably continue to trade sideways or see a lot of volatility here in this negative gamma zone. So look, the S&P 500 looks all right. A lot of work to be done for the NASDAQ 100. The RSP actually looks pretty good. If you ask me, it looks like we're building a solid base right here after having built a solid base right here. And that probably lends itself to us going higher. I think the RSP looks very, very constructive. But let's look at a couple of other proxies. Gold, we know I've been talking about this for a while. I want to see gold pull back to this level right here. We did pull back. We did see quite a lot of buyers take positions here at the 2800 level, but I just want to see it inside this level right here. And that's probably where I will load up on gold. Would love to see that. That would be great if we could get gold to that level. I already spoke about Bitcoin. I'd probably start dollar cost averaging here and look to as low as the $65,000 mark. And then let's actually look at the dollar. We're seeing a little bit of strength here at the dollar. So we didn't quite get to this level right here. Now, this is actually looking like a higher low relative to this low right here. But as long as we stay below this area, if we can actually continue to rally in the dollar and then we actually find resistance, that would actually be a lower high, relatively speaking. But if we go ahead and break above that, then we probably see more upside in the dollar. So if you're a dollar bear, which you do want to be right now, you want to see some weakness in the dollar before we get to the 109 area, just to signal a continuation of the downtrend. But these tariff policies that Donald Trump's been enacting, we're seeing a little bit of strength in the dollar. I think we're also seeing just a little bit of shorts getting covered right here in the last couple of days. Just people taking profits on some of the shorts that they've had in the dollar. I do know that hedge funds use the DXY as a great hedging tool, particularly for their international position. So we could be seeing a little bit of an unwind there. Nonetheless, guys, the dollar still in a very clear downtrend. It's looking like a higher low, relatively speaking, but like if we continue to find weakness, we can just continue the downward momentum. And then looking at the 10-year yields are very, very attractive, right? Yields are moving to my absolute critical zone of 1.52. This was the low right here. We're pretty much there. And guys, because of where the 10-year yield is right now, equities start to look really, really attractive again. A 4.2% yield. It probably means your DCF discount rate is probably closer to 8.5% now, more than it is like 9.5, potentially 10% here at the 4.8% range. So yeah, I think this is another reason why we actually did see quite a lot of dip buying in the S&P 500. Like this was definitely a solid amount of dip buying, and that's because we are seeing yield pull back. The dollar remain a little bit resilient, but coming down as well. So yields in the dollar falling, and that bodes really well for just like large cap equities, mid cap equities, and small cap equities. And I think that's part of the reason why we're seeing an opportunity to buy the dip. Other than the fact, like when you look at something like Nvidia, like on a peak to trough basis, right? You pull that back and Nvidia's down 23%. That is technically called a crash. 10% is a correction, right? 20% is actually called a crash. And I think anything greater than 25% is called a major crash / depression. So guys, look, if you like names, I do like Nvidia. I really do like Nvidia. I do like Meta as well. I think this is a great stock, but it's down significantly from its highs as well. I think it's like 15% peak to trough, 13% peak to trough. I like Nvidia. I like Meta in the large cap space. I do like EVVTY. Anything below 76, I actually bought more of this today. And then a stock that I think is a great buy right now as well is PayPal. It's at the $70 range. I know it does look like it's in a downtrend, but this is where you're going to find very, very strong support for PayPal at this level right here, especially if we just put in a trend line right here, sort of at the 60 to 70 level, this area right here, you're going to find very, very strong support because we used it as resistance multiple times at these levels right here. And then it turned into support and rocketed the way up to $92. I think we're going to see these highs again for PayPal sometime. We just have to digest the earnings and see what management has in store. But buybacks continue. There's $15 billion worth of buybacks authorized for PayPal. I really find PayPal attractive at these levels right here. But for all intents and purposes, guys, I think you want to start buying the dip in the equities and indices you like. I said that yesterday. For those of you that bought the dip, very, very good. But guys, keep cash spare, because we could definitely go lower. A lot is going to be dependent next week on the non-farm. So pay attention, subscribe so you don't miss a beat. Follow me on my second channel, and let's get into sentiment and seasonality. And guys, let's talk about sentiment. This is something I wanted to touch on again from yesterday, just the AA sentiment survey. And guys, what we really are seeing here is just real capitulation. Last time we actually had lows of 19% in bullish territory, excluding 2020. You have to go back to 2008, right? So we are really seeing a huge divergence, a big uptick in bearish sentiment, and that has really been reflected in the price of stocks. And like I said yesterday, this is where you want to be a buyer, guys, because the 12-month return for the S&P 500, when the AA bearish sentiment votes hit 60% or more, was 17% with a hit rate of 92%. That means 92% of the time you'll finish higher 12 months later. And I think the reason why we've seen the sentiment is because people are concerned about a growth scare. You can see here the ratio of stocks to bonds, proxied by the ETF SPY and TLT, has moved perfectly in alignment with the futures contract trying to predict the Fed funds rate. Pretty much what this tells us right now is that the market is concerned about growth. There is a little bit of a growth scare, particularly with economic growth as it pertains to tariffs, the economy, the outlook, taxes, foreign and geopolitical tensions. All of that is coming to the front of mind of investors. The second there's a growth scare, you're going to get volatility. But I do want to point a couple of things out. Right now, this is exactly what a growth scare looks like. This is what a growth scare looks like. Credit spreads haven't really ticked up in any major way. And this is AA corporate bonds versus US Treasury bonds. Yes, we have seen a mild uptick here in credit spreads, but we haven't seen anything significant. This was 2020 when we had the coronavirus. Credit spreads are still very tame. So while optically it may look like a growth scare, to me, with credit spreads this tight, what it's really telling me is that we're just seeing a bit of a momentum unwind and a bit of seasonals at play. And because we've had such linear returns in the last 2 years, retail traders, investors as a whole are getting shaken out of their positions. But when you look at the seasonals, and this is NDR's S&P 500 composite cycle for 2025, and it places an equal weight on the 1-year seasonal cycle, the 4-year presidential cycle, and the 10-year decennial cycle. And we've actually tracked it very, very closely. We see quite a rally here into the start of the year. Then over the next couple of months, from about middle of February to as late as middle April, we actually see quite a lot of volatility, sideways action. This actually tends to be a low. This yellow line is where we are right now. So we put in a low right here. And this is why I say you want to buy the dip, because everything is telling us that we do go higher. The seasonals is telling us we go higher. The credit markets are telling us not to be concerned right now. And the earnings picture is very, very robust. After Nvidia's earnings, Q4 earnings are pretty much done. And it has been an amazing quarter for earnings. S&P 500 earnings growth, nearly 17%. The expectation coming into this quarter was for 9.7% earnings growth. And if you actually just exclude energy, you're looking at close to 21% in S&P 500 earnings growth, revenue at 5.2%. And again, if you remove energy, you're looking at close to 7% in overall revenue growth, but 64% of companies reporting above analyst expectations for revenue and 74% here for earnings. So it has been a fantastic earnings season. And as the market pulls back, if earnings continue to do this, by and large, stocks, the S&P 500 and the market as a whole simply just gets cheaper, and it's your opportunity. And this provides you, the investor, an opportunity to get long. So buy the fear because also the macro picture looking by and large pretty good. GDP came in as expected. This was the fourth quarter revisions. We saw 2.3%. That's pretty much what the consensus was. So nothing too crazy there. We've also seen that the economic surprise index hasn't actually been that bad. I know it feels like economic data has come in really sour. While it has been a little bit worse than usual, anything above the zero line means economic data is coming in better than analysts' expectations. Below, it's coming in worse. We have seen economic data recently coming slightly worse than expected, but nothing too crazy. And by and large, for the better part of the last 6 months, we've seen very strong economic data. All we're seeing is just a moderation of that data. But what data do we have next week? We have ISM manufacturing PMIs on Monday. They're going to kick things off. That's just manufacturing data. And we have services PMIs on Wednesday. We do have quite a number of things in between, but this is just the high impact data, 3 stars worth. And then on Friday, we have non-farm payrolls, the unemployment rate, and we also get stuff like average hourly earnings month over month, year over year. So we also get that. It's sort of like inflation data to a degree. So next week is going to be a very big week of data, specifically these payrolls and everything in between, stuff like initial jobless claims, ADP numbers. Looking at earnings, we have a pretty big week as well. Not as big as this past week, but some pretty big names. AVGO, Broadcom is reporting earnings tomorrow. That's the biggest company reporting. We also have Costco, very big company, $500 billion in US market cap. Costco is reporting. So too is CrowdStrike, Marvell Technology, SEC Limited, JD AutoZone, Flutter Entertainment, Kroger Company, Ross Stores, pretty big names, Viva Systems, Zscaler, Hewlett Packard, MongoDB, Best Buy. So there's definitely some high impact names. It seems like there's a lot of like staple companies, dollar stores. So we're actually going to get a lot of earnings from the consumer side, particularly with like Costco, stuff like that. And then we're also going to get some stuff from like tech names, ABGO, CrowdStrike, Marvell, C Limited, some China names reporting as well, AutoZone. So very interesting week ahead, and as it pertains to the earnings picture as a whole. But your high impact names are here, AVGO, Costco, and CrowdStrike. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.